Okay, so here I'm going to explain how to actually do this type of valuation of a company using the local investor, angel investor approach, which is a market approach. So the first thing that you have to have done before you value the company is you have to have your income statement, your pro forma income statement completed that maps out the revenue and profit for the company for the next 5 years. From that financial statement, the pro forma income statement, you are able to get these two numbers. This number is the top line revenue in year 5. So what you project to be your revenue in year 5, and then this is the EBITDA in year 5, which is earnings before interest, taxes, depreciation, and amortization. Okay, so these are from year 5. You get these numbers, and then we're just using these multiples that are common here in Las Vegas of 2 times revenue or 5 times EBITDA. Using those multiples, that says that the company, if you use the multiple based on revenue, would be worth $5 million in year 5. Or using the multiple based on EBITDA would be worth $6.5 million. So the value of the company could be somewhere between $5 and $6.5 million in year 5. We could choose a number in there. The next bit of information that needs to be entered is what rate of return or return on investment the investor requires. So angel investors typically they think of this: I put $1 in now, and how many dollars do I want to have as return in 5 years? So in this case, let's just try to put in 20. The number should be between 10 and 30. And of course this is open to negotiation, but we're just trying to get an idea of an estimate of the value. In reality, it will depend on who you want to have as your investor, and so it's totally up for negotiation, but I'm trying to give you kind of the process of how a company is valued, a startup is valued. So if an investor wants to take every dollar that they have now and turn them into $20 in 5 years, then we can reverse the process using the valuation in year 5 and back calculate what the value of the company would have to be now to be worth 20 times that in 5 years. So basically we take these values in year 5 and divide them by 20 in this case, and that means that the value of the company is somewhere between $250,000 and $325,000. So we could say, okay, well, we think that the company is worth maybe $300,000, somewhere in that range. So we type that in. So if that's the value of the company, then we have to figure out, well, how much investment do we actually need from an investor? And where you get that number is if you are figuring out how much money you need to get started. You're going to be using this statement that we call the sources and uses of funds, and I'll zoom in here a little bit. First, you need to, in your planning, you'll have to figure out how much money do we need to get this started for equipment, for leasehold improvements, inventory, to pay people, for marketing, to have reserve. And so this example here, I show it totals 287. Okay, so that 287 has to come from somewhere, and so you could maybe get take a personal loan, a mortgage, or a short-term loan from somebody that you might know. A bank probably wouldn't give you the money. The investment from principals, and then whatever is left over should come from equity investors.